Stocks finished mixed on Friday as bond yields soared following the strong July jobs report. At the close, the Nasdaq was the biggest laggard among the indexes, falling 0.5%, while the S&P 500 fell 0.2% and the Dow rose 0.2%. In July, the U.S. economy added 528,000 jobs as the unemployment rate fell to 3.5%. Economists had expected job growth of less than half the July reading. And, as one can imagine, the bond market reflected the fact that further Fed rate hikes are expected, with the 10-year note up to 2.84%. This will likely keep the Federal Reserve on track to continue with aggressive interest rate hikes, perhaps another three-quarter rate hike in September. At the same time, the yield curve moved deeper into inversion, again signaling recession ahead. Since mid-June, the S&P 500 has gained over 10% as investors grew optimistic a potential pivot or slowdown in the pace of rate hikes would come from the Fed. I think that now is a pipe dream, and I'm still cautious. The Fed also released June data showing that consumers piled on another $40 billion of credit in the month. This is the second largest monthly spike in consumer credit history. To me, if one needs to pile on more credit, then all those new jobs might not be all that great. And so history does not support the idea the Fed can engineer a soft landing. Since 1972, every single time inflation, as measured by yearly CPI, spiked higher, the Fed followed with tightening. And what happened? Each and every time, with the exception of 1984, a recession soon followed. This time will not be different. So I put out a call to Captain Sully to see if he can deliver us a soft landing. Two quick charts today, beginning here with the 20-year monthly chart on the spiders, the SPY, in the close on Friday of 413.47. So we came on down here, we bounced off of that 50 EMA and right up into the 20 EMA. Now, do we have enough strength to move up and through? I would say just barely more probable than a reflection, at least at this time. But I think the upside is limited. Moving on down here, we can see that volume is not going to tell us too much, but here the MACD does. The fast line at this point versus the slow line at that point. This separation means volatility. It also means we need a lot of time to bottom and base and heal before we can move on up. Going back to some of these other reverses, there was Fed money behind those. We don't have it this time, so it's going to be more painful, perhaps more lengthy. Here in the histogram, we can see that this is very deep. We do have a few months of improvement, but I think that's fleeting. Moving here into the price rate of change, you can see there's small fish hook. I don't like those with that separation. Into the relative strength index, you can see that it's bounced back on up to that 50 or midline, but once again, is this bounce up to the midline like this bounce here back in 2008? I'm watching out for that. You can see some similarities here also in the stochastics with this fish hook at this point, big separation, and there's a fish hook at that point too. So I'm just not trusting this rally. I think it's built on sand. Same thing here with the Williams. Back on up to the price chart. And one last look. And now let's go ahead and take a look at the daily chart. And now we're looking at the 6-month daily chart on the spiders, and you can see that we had a relatively long bottoming and basing here with the bottom there in mid-June, and we've climbed out. It was a little difficult climbing out of that 20 and 50 EMA and on up, but we're at this point here, and as you can see, perhaps a little bit of a rollover that we can see right now, and that's pretty much equidistant to this rollover here. So oftentimes that'll happen. We might head back down, retrench, and then get enough strength for another move up. So we'll have to watch that into next week and the week after. I think it's running out of steam, so we got to be careful. Moving here, you can see the volume is dropping, and that's not necessarily a good sign when you're heading on up in the market. But as you can see also here in the MACD, is this a rollover at this point? Well, it was back here. So keep your eye on that. Into the histogram, pretty much the same thing as well there in the price rate of change, and the RSI definitely looks like the possibility of a rollover. Same thing in stochastics. That looks like a rollover, and into Williams. So be cautious and be careful. I would say that I'm going to stay on the sidelines. It's been a while, and I'm going to continue to be patient. I do want some opportunities. There are opportunities coming, but I just tend to think that more opportunities will be there if I'm patient. And for today, that's ChewDog Charts. Thank you.